Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Rezolve AI.
If you find our talks useful, please consider subscribe, like, and comment underneath. So imagine finding a stock just buried in the $2 bin,
Right.
completely ignored by the mainstream retail crowd, right as the underlying company quietly alerts Wall Street that they're about to pull in $360 million in forward revenue.
Yeah, that mathematical disconnect is, well, it's exactly what we're looking at today.
Right, because we have a scenario here that really demands your attention if you're serious about your medium-term portfolio growth. I mean, on the surface, you see a share price hovering around $2.50, and usually...
Currently, that's a huge red flag.
Exactly. That price tag signals a struggling operation.
Yeah.
But when you peel back the financial layers here, you find this explosive, highly validated commercialization.
Yeah, the contrast between that current share price and the forward guidance is the kind of anomaly that forces institutional investors to, completely rebuild their valuation models.
Oh, absolutely.
We are evaluating what looks like an 8.5 out of 10 bullish setup. And the mission for you as a wealth-building listener isn't just to recap an earnings report.
Right. No one needs just another recap.
Exactly. It's to understand the mechanics of how a stock at this specific price level justifies such massive internal growth. And more importantly, to decide if the timeline of this play warrants a dedicated allocation in your medium-term portfolio.
Yeah, so let's start by unpacking that fundamental shockwave that put this on the radar in the first place, because we're always looking for inflection points, right? Those rare moments where a company successfully transitions from the developmental cool idea phase into high-velocity commercialization.
Yeah, the actual money-making phase.
Exactly. So the official numbers for their full year 2025 just dropped, and they reported GAAP revenue of $46.8 million, which completely crushed the consensus Wall Street estimates. Those were sitting down at $41.2 million.
Yeah, a solid beat.
It is, but frankly, a $5 million beat isn't what makes a stock an 8.5 out of 10 setup.
No, it's not. The sheer velocity of the revenue generation is the real story here. I mean, to understand the momentum, you have to split the year in half.
Okay, lay that up for us.
So during the first 6 months, the company only generated $6.3 million in revenue. They were essentially just, warming up the engine.
Right.
But in the second half of the year, that revenue figure just exploded. We are talking about a 543% jump compared to the first half.
Wait, let me make sure I have this math right, because that almost sounds like a typo in an earnings release.
Yeah.
They did $6 million in the first half.
Yeah, just over 6.
And then jumped over 500% in the back half.
Exactly.
That is not organic, slow and steady market capture. That's a massive switch being flipped. I mean, it's like spending 3 years and millions of dollars building a massive 10-lane digital highway and then suddenly opening all the toll gates on day one.
That's a great way to put it.
And you really see it peaking at the end of the year. Like their December monthly recurring revenue, the MRR, hit $19.4 million.
Right.
If you take that single month of momentum and annualize it, you're looking at a current run rate of over $232 million.
Yeah, which entirely explains why management just updated their fiscal year 26 revenue guidance to that astounding $360 million figure.
It's wild.
It really is. Management is explicitly signaling that the December momentum wasn't some fluke. It is the new baseline. The market is currently trying to digest this massive pivot from a low historical revenue base to this forward-looking reality that's just scaling at breakneck speed.
But I do want to push back here for a second. Because as a disciplined wealth builder, you always have to protect your downside.
Always.
Revenue is great, and a 500% jump makes a beautiful headline. However, their official bottom-line accounting loss, this GAAP net loss, was 38 cents a share.
Right.
So I have to ask the skeptical question. Are we just looking at a cash-burning machine? You know the type, we see it all the time in the tech sector.
Oh yeah, buying growth.
Exactly. The companies that buy their top-line revenue at all costs by handing out massive discounts, but never actually figure out how to make a single dime of actual profit.
That is the right question to ask. Evaluating the quality of the revenue is crucial when you're looking at early-stage hypergrowth. So let's look at the context of that 38-cent loss to see if they're just buying growth.
Okay.
First, the consensus analyst expectation was worse. Wall Street was actually bracing for a 43-cent loss.
Oh, interesting. So they beat on the bottom line, too.
They did. But the real insight comes from looking at the previous year, where this exact same company had a net loss of $1.06 per share.
Wow, okay. That's a big drop.
Yeah, what you are witnessing is operating leverage in action. The loss is narrowing dramatically year over year while the revenue goes parabolic. So this isn't a cash-burning machine spiraling out of control. It's the classic playbook of an enterprise software company growing into its fixed overhead costs.
Okay, so the scaling process is actually functioning the way it's supposed to. The heavy infrastructure is already built, they've paid for the expensive foundation, and now the flood of new revenue is finally outpacing those day-to-day operating expenses.
Precisely.
Which brings us to the obvious question, Trey.
Uh-huh.
How are they doing it? What is the actual product mechanism that triggers a 500+% jump in the back half of a year?
Well, they call their competitive moat agentic commerce.
Agentic commerce.
Okay. Yeah, and to understand why agentic commerce commands such a premium, you have to separate it from the AI most people interact with daily. Right now, the broader market is just saturated with generic large language models.
That's the standard chatbots.
Exactly. Those generic models are fundamentally designed for conversational interactions and information retrieval. You ask a question, it synthesizes a paragraph of text.
Yeah.
But Rezolve AI has built a completely different infrastructure. It's tailored exclusively for the retail and e-commerce sectors, and its sole purpose is to drive and finalize actual financial transactions.
Let me try to frame this because I think understanding this distinction is the whole ball game for why their revenue is exploding.
Go for it.
Generic AI is like going to a massive department store and finding a digital greeter at the front door. You say, I need a blue button-down shirt, and the greeter says, the blue shirts are located in aisle 4.
Right. Helpful, but that's it.
Exactly. Helpful, sure, but the interaction ends there.
Yeah.
Agentic commerce is like walking in and being handed a top-tier, white-glove personal shopper. This AI doesn't just point to the aisle. It actively finds the shirt in your exact size, suggests the matching tie that you didn't even know you wanted, handles the complex return policy questions without human intervention, and then literally acts as the checkout counter to swipe your card and close the sale.
That's a perfect analogy. And take that personal shopper analogy one step further. Not only does it find the shirt and swipe the card, but because it's handling the actual transaction from start to finish, it captures the proprietary data of that purchase.
Oh, right. The data is gold.
Exactly. It's the difference between simply providing a search result and executing a measurable revenue-generating outcome for the retailer. Because this specialized software directly increases a retailer's bottom line, it comes with immense pricing power.
And we can see the reality of that pricing power directly in their margins, right? I mean, their core software business is delivering gross margins exceeding 90%.
Yeah, 90%.
90%. I mean, for anyone tracking tech fundamentals, that is the holy grail of enterprise software. It means that once the underlying code is written and deployed, almost every single new dollar of revenue from a client just falls straight down the income statement.
It really does. Now, to be transparent on the blended metrics, their total GAAP gross margin for the year factored out to 66% once you include their other operational segments.
Sure.
But that core software margin sitting over 90% is the proof of concept. It proves that the underlying agentic product has an incredibly high value proposition and, more importantly, massive switching costs.
Right. Like once you're in, you're in.
Exactly. Once a retailer embeds this AI into their checkout flow, removing it becomes a complete logistical nightmare.
Yeah, and if this AI personal shopper is as sticky as those margins suggest, it totally explains the massive corporate gamble they just took.
Oh, the acquisition.
Yeah. In February of 2026, they acquired a company called Reward for $230 million. And for a company trading in the $2 range, deploying $230 million is an astronomically aggressive move.
It's massive.
Right. $230 million is a pretty expensive way to buy an engagement tool. As an investor, the last thing I want is to hold the bag while two different IT departments spend a year fighting over which legacy database to use.
Yeah, integration is tough.
So is this acquisition the catalyst that sends the stock running? Or is this the operational risk that breaks the entire thesis?
Well, the dual nature of aggressive M&A is exactly what makes this a high volatility play. On the strategic side, acquiring Reward is a masterstroke to deepen their competitive moat.
Okay, how so?
It allows them to integrate powerful, established customer engagement and loyalty tools directly into their AI. They are essentially locking their retail clients into a closed-loop ecosystem. A retailer uses the AI to make the sale and the reward network to keep the customer coming back.
So it makes the core product even harder for a competitor to rip out.
That is the upside.
Uh,
But the operational reality of merging two tech stacks is the primary bear case risk here. Corporate integration is notoriously difficult.
yeah, we've seen it fail so many times.
Right. You're merging distinct company cultures, aligning redundancies, and trying to make disparate software languages communicate seamlessly. If the integration of reward is clunky, delayed, or requires massive troubleshooting, those beautiful 90% software margins we just talked about could get severely diluted by unforeseen integration costs.
So the risk is that they bought a great tool but break their own margins trying to plug it in.
Exactly. But look at management's behavior immediately following this specific acquisition. Instead of issuing cautious wait-and-see guidance while they integrate.
Which is what you'd expect, normally.
Right. Instead, they immediately raised their forward guidance to that staggering $360 million figure. A leadership team does not raise forward guidance by that magnitude unless they possess supreme internal confidence in the immediate cross-selling power of the newly combined entity.
That's a great point.
They clearly see a frictionless path to monetizing the reward acquisition right out of the gate.
So if management is that confident, and the personal shopper AI is driving that kind of margin, how is Wall Street reacting? Let's look at the footprints the institutions are leaving behind, because the price action and the volume following this earnings release are telling a wild story of their own.
Oh, the market mechanics here illustrate a textbook volatility breakout. Following the release of these numbers, the stock didn't just experience a slow, optimistic drift higher, it violently gapped up.
Right.
It had previously closed at $2.39. On the open, it gapped all the way up to $2.86.
A gap up of that size shows massive pent-up demand. I mean, it tells you that buyers were so desperate to secure a position overnight that they completely blew past the previous day's closing price.
Yeah.
And even though the price eventually settled around $2.52 during the intraday session, it did so on absolutely staggering volume. Over 31.7 million shares traded hands.
Which is huge for this ticker.
Exactly. To put that in perspective for you, 31 million shares changing hands on a stock like this is a massive changing of the guard. It's a complete capitulation event. Anyone who was tired of holding this stock while it was dormant over the last year finally sold on the morning pop. But the critical part is that their shares were immediately absorbed by aggressive, highly motivated accumulation from new buyers.
Yeah, that specific kind of volume transfer, where old, fatigued capital is replaced by new, convicted capital, is very often the precursor to a definitive bottoming process and a major trend reversal. But if you really want to see where the sophisticated, smart money is placing its bets, you have to look away from the standard stock chart and look at the derivatives market. The options flow on this is flashing extreme directional signals.
Yeah, options data can be incredibly dense, so let's break down the mechanics of what we're actually seeing there.
So institutional traders purchased nearly 28,000 call options. That represents a 53% spike above the average daily volume.
Wow.
Right. And call options fundamentally are leveraged directional bets that the underlying stock price is going to rise. But the real tell here isn't just the volume of calls, it's the implied volatility attached to them.
Okay, lay the IV numbers on us.
The implied volatility on these specific options is sitting at an astronomical 247.8%.
248%.
Yeah.
I mean, for anyone listening who doesn't actively trade derivatives, implied volatility is basically the market's mathematical expectation of future chaos.
Yeah, chaos is a good word for it.
To give you context, a normal, stable blue-chip stock might have an implied volatility of 20%. Even high-flying tech stocks usually sit around 60 or 70%.
Right.
An implied volatility of 248% is like pricing in the insurance premiums on a house that is currently sitting in the direct path of a Category 5 hurricane. It means the options market is literally screaming that a violent price swing of 20% or more is imminent.
And sophisticated institutional players and market makers, they don't pay the massive cash premiums associated with 248% implied volatility unless they are anticipating a significant fundamental re-rating of the stock.
They're essentially putting their money where their mouth is.
Exactly. They are betting heavily that the broader market is about to fully digest the reality of that new $360 million forward guidance. And when the broader market wakes up to that math, the repricing will be fast and aggressive.
And it isn't just the aggressive options traders making these bets either. The Wall Street analysts, the folks whose entire job is to build intricate, conservative, discounted cash flow models, they're overwhelmingly bullish.
Oh, totally.
We're looking at a mean price target from 6 different analysts
Yeah.
sitting at $11.25.
Let the spread on that math sink in for a moment.
That's
The
like,
stock is currently trading near $2.50, and the consensus Wall Street target is $11.25.
it's crazy.
That implies a potential upside of over 300% just to reach the average estimate of fair value.
Wall Street is practically tripping over itself to upgrade this, and the individual targets show a fascinating spread. Like, Maxim Group reaffirmed a buy rating with a highly aggressive $15 target.
Right.
IA Financial set their target at $14. H.C. Wainwright reiterated a $12 target. But perhaps the most telling is Cantor Fitzgerald.
Yeah, they're the conservative ones.
Exactly. They are notoriously the most conservative of the bunch, yet even they reiterated an overweight rating with an $8 target. When the absolute most pessimistic conservative estimate on Wall Street represents more than a 200% premium to the current trading price, you have to pay attention to the disconnect.
The consensus is undeniable. Which brings us to the actionable framework for you as a wealth builder. How do you position for a fundamental disconnect of this magnitude? Like, what is the actual timeline required to capture this re-rating?
Right, because you don't just blindly buy a stock, stare at your brokerage app, and hope it goes up by tomorrow afternoon.
Yeah.
You need a structured timeline.
Exactly.
Based on the fundamental scaling and the upcoming catalysts, this sets up as a classic medium-term hold. We're talking about a 6 to 12-month target horizon. This isn't a quick day trade. This allocation is designed to capture the entire re-rating cycle as the company converts its current blistering momentum into that guided revenue.
And over that specific 6 to 12-month horizon, there is a distinct sequence of catalysts you need to track.
Okay, what's first?
The immediate catalyst is the post-earnings drift and the continuous wave of analyst model updates. As these institutions literally punch the new $360 million guidance into their spreadsheets over the next few weeks, you are going to see a steady drumbeat of reiterated buy ratings, which drives institutional accumulation.
There is also a much broader macro tailwind working in their favor right now, too. The S&P 500 has been showing a broader market rebound that is heavily favoring risk-on, small-cap AI equities.
Oh, yeah. The macro environment is huge.
When the macro environment shifts to a risk-on appetite, a small-cap stock demonstrating a 500% revenue growth rate becomes incredibly magnetic to large funds looking for alpha.
Spot on. And as we move past the immediate term and into the medium term, the defining catalyst will undoubtedly be the integration milestones from the reward acquisition.
Right, checking if they actually broke it or not.
Exactly. The market is going to be scrutinizing their upcoming quarterly reports for client retention metrics and cross-selling success. If management proves they can integrate rewards smoothly without blowing up those 90% software margins, that is the exact moment you will likely see the stock aggressively close the gap toward those double-digit analyst targets.
Now, there is one more wildcard catalyst we have to discuss, but I want to be very careful here. We are seeing a massive amount of retail chatter and forum activity surrounding their warrants.
Ah, yes.
The warrants are currently trading around $2, but they have projected targets of $8. The prevailing theory floating around the retail boards is that if the underlying stock can organically breach the $18 to $20 threshold, it could trigger these warrant calls, potentially creating a highly leveraged short squeeze or a mechanical buying frenzy. But, and I want to push back on this narrative hard, as a disciplined wealth builder, you have to be incredibly cautious with retail forum rumors about short squeezes. It seems like every day there is a new post screaming about the next massive squeeze, and 9 times out of 10, retail gets left holding the bag. Let's not get distracted by the noise. Let's focus on the actual mechanics of the business.
Focusing on the business mechanics over the retail hype is exactly the right approach. Relying on a theoretical short squeeze or a mechanical warrant frenzy is pure speculation, not sound investing.
Exactly.
If a mechanical buying frenzy happens to occur because the stock breaches $20, well, consider it a happy accident. But synthesize the final thesis here. Strip away the meme stock rumors entirely. The true value proposition for your portfolio is the pure, unadulterated, fundamental disconnect. You have a share price sitting at $2.50. You have a company that just exited the year with a $232 million annualized run rate, is officially projecting $360 million next year, and is operating with core software margins over 90%.
It's the math that matters.
That fundamental math is what makes this a compelling, high volatility, long opportunity. You don't need a theoretical short squeeze when the underlying business model is scaling this violently on its own merits.
So what does this all mean for you and your medium-term portfolio? To wrap this up, Rezolve AI has decisively proven that its agentic commerce model scales in the real world.
Yeah.
The transition from the developmental phase to high-velocity commercialization is no longer just a bullish theory on paper. It is a mathematical reality reflected in a 543% second-half revenue explosion. The market is just now, this week, beginning to wake up to the math. The derivatives market is pricing in a violent, imminent move, and Wall Street is pointing to a minimum 300% upside just to reach their average fair value targets.
I want to leave you with one final, broader question to mull over as you evaluate this setup. We've spent our time focused on the internal math, and we've discussed the personal shopper AI moat.
Wait.
But look further down the road. If their transactional agentic commerce successfully integrates with the massive reward network across all these disparate retailers, are we just looking at a successful high-margin software company? Or are we actually looking at the underlying transactional plumbing for the entire future of digital retail? If they truly become the invisible checkout engine of the internet, embedded in every digital interaction we make, how long before the legacy tech giants, those trillion-dollar behemoths who rely on generic search and generic AI, are forced to either compete with them directly or simply buy them out completely?